If you're over 60 and you own your home in Canada, there is a real chance you are quietly leaving thousands of dollars on the table every single year, money the government has already set aside for you, that you simply haven't claimed. Not because you don't qualify. Because nobody told you which forms to file. I'm not talking about some obscure loophole. I'm talking about 5 specific documents, real CRA forms, with real form numbers, that most Canadian homeowners over 60 have never even heard of. Some of them are worth up to $7,500 in a single year. One of them can let you defer your property taxes entirely until you sell your home, and the deadlines on some of these are stricter than you'd think. So sit tight, because by the end of this video, you'll know exactly what to file, what it's worth, and how to get it done, step by step. Here's the thing about the CRA. It doesn't call you up and say, hey, you qualify for this. These are what's called demand-driven benefits, meaning if you don't file the paperwork, the money simply stays with the government, every year. And seniors get hit hardest by this, for one simple reason. A lot of these programs are new, or they were changed in the last few years, and the people who'd benefit most are the least likely to be online reading CRA bulletins. I'm going to walk you through 5 documents. For each one, I'll tell you 3 things: what it is, what it's actually worth in your pocket, and exactly how to file it. Form numbers included, so you can write these down or pause the video. Now, before we go further, I know what some of you are thinking. If this were real, my accountant would have told me. Fair question. The truth is, a lot of these credits are self-reported, meaning the CRA doesn't proactively flag them, and unless your accountant specifically asks about your age, your home, and your health, they can slip through the cracks completely legally, and completely by accident. Let's get into it. What is it? The Disability Tax Credit, or DTC, is a certificate, not automatically a cash payment, but a key that unlocks several other benefits. It confirms to the CRA that you have a significant, prolonged impairment. This could be mobility issues, vision loss, hearing loss, or a number of chronic conditions that many people over 60 live with but never think to report. What is it worth? On its own, the federal DTC can reduce your tax bill by roughly $1,700 to $2,000 a year, depending on your province. But here's the real value. Once you're approved, it opens the door to the Home Accessibility Tax Credit, the Multigenerational Home Renovation Tax Credit, and even retroactive claims. The CRA allows you to go back up to 10 years if you were eligible and never claimed it. That retroactive piece alone has put 5-figure refunds in people's pockets. How do they get it? You or your doctor fills out Form T-2201, the Disability Tax Credit Certificate. Part A is your information. Part B is completed and signed by a medical practitioner. This can be your family doctor, a nurse practitioner, or a specialist depending on the condition. You submit it to the CRA either through your CRA My Account online or by mail. Processing typically takes 8 to 12 weeks, so don't leave this until tax season. You might be asking, is this legal? Isn't this the kind of thing that gets audited? Actually, it's the opposite. The CRA created this form specifically so people would apply. An audit risk comes from claiming something you don't qualify for, not from filing a legitimate medical certificate signed by your own doctor. This is simply Canada's tax system doing what it was designed to do. What is it? This credit helps cover the cost of renovations that make your home safer or more accessible. Think walk-in tubs, wheelchair ramps, grab bars, wider doorways, or non-slip flooring. It's designed for people who want to stay in their own home longer instead of moving into assisted living. What is it worth? You can claim 15% of up to $20,000 in eligible renovation expenses, which works out to a maximum credit of $3,000 in a single tax year. To qualify, you need to be 65 or older by the end of the year, or you, or someone living with you, needs to be eligible for that disability tax credit we just talked about. How do they get it? Keep every invoice and receipt for the renovation. The CRA wants proof the work was performed and materials were purchased. Then, when you file your return, you report the amount on line 31285 of your T1 tax return. No separate application form. It's claimed directly at tax time, but the documentation has to be airtight if the CRA ever asks for it. What is it? This one is newer and far less well known. If you renovate your home to create a self-contained secondary unit, with its own entrance, kitchen, bathroom, and sleeping area, so that a senior or a person eligible for the disability tax credit can live with family, you may qualify. Think basement apartment, garage conversion, or even a laneway house. What is it worth? This is the big one. You can claim 15% of up to $50,000 in eligible renovation costs, for a maximum refund of $7,500. And here's what makes it powerful. It's a refundable credit, meaning you get that money back even if you don't owe any tax that year. How do they get it? The renovation has to be completed, not just started, in the tax year you're claiming it. You report the amount on Schedule 12, line 45355 of your federal return. Keep in mind you can only use this credit once per qualifying individual in their lifetime, and you can't double dip by claiming the same expenses under both this credit and the home accessibility tax credit. So if you're eligible for both, run the numbers to see which one benefits you more. Now you might be wondering, why hasn't my contractor or my bank mentioned this? Simple answer, it's not their job. Contractors are focused on the renovation, banks are focused on the mortgage. Nobody in that chain is incentivized to tell you about a tax credit. That's exactly why so much of this money goes unclaimed every single year. What is it? This one isn't a CRA form, it's a provincial program, and it's one of the most underused benefits for senior homeowners in Canada. If your property taxes are becoming a burden, most provinces allow eligible seniors to defer paying them entirely, with the balance owed only when the home is sold or transferred. British Columbia's version, for example, is called the Property Tax Deferment Program, and similar programs exist in Ontario, Alberta, Manitoba, and other provinces under different names. What is it worth? This isn't a one-time credit, it's ongoing relief. If your annual property tax bill is $4,000 or $5,000, deferring it means that money stays in your bank account, year after year, instead of going out the door. The government registers a low-interest lien against your home, and you settle it later, typically from the proceeds when the home is eventually sold. How do they get it? You'll need to check your specific province's application. In BC, for instance, it's an online application through the provincial government's property tax deferment portal, and you generally need to be 55 or older, have a minimum amount of equity in your home, and current home insurance. This is not automatic. You have to apply and requalify some years, so don't assume once you're in, you're set for life. Check your renewal requirements. Some of you are thinking, if I defer my taxes, doesn't that just mean I owe more later, plus interest? It's a fair concern. The interest rates on these provincial deferral programs are typically well below market mortgage rates, and for many seniors on a fixed income, freeing up cash flow today is worth far more than a small interest cost paid from the home's eventual sale proceeds. It's not free money, but it's a tool worth understanding, not ignoring. What is it? Here's one that catches people off guard. Since 2016, the CRA requires you to report the sale of your principal residence on your tax return, even though the sale itself is usually tax-free. If you sell your home, or if you've ever changed its use, for example, converting part of it into a rental unit, or moving into a care facility and renting the home out, you need to formally designate it. What is it worth? Get this wrong, and the tax-free status of your home sale isn't automatic. The CRA can deny the exemption entirely, or worse, apply penalties for late reporting. On a home that's appreciated by several $100,000 over the decades, that exemption is easily the single largest tax benefit most Canadians will ever receive in their lifetime. How do they get it? When you sell or change the use of your principal residence, you report the sale on Schedule 3 of your T1 return and complete the principal residence designation section on Form T-2991, or the relevant CRA schedule for your situation. If you're not selling but you're changing how the property is used, say part of it becomes a rental, talk to a tax professional before you do it, because that change alone can trigger a deemed disposition, which has its own reporting requirements. Let's bring it all together. 5 documents, 5 opportunities. Number 1, the T-2201 Disability Tax Credit Certificate, your key to unlocking multiple other benefits. Number 2, the Home Accessibility Tax Credit on line 31285, up to $3,000 for safety renovations. Number 3, the Multigenerational Home Renovation Tax Credit on line 45355, up to $7,500, refundable. Number 4, your province's Property Tax Deferral Program, ongoing relief from your annual tax bill. Number 5, Schedule 3 and your principal residence designation, protecting what is likely the single biggest tax-free asset you own. None of these are secrets. They're published, they're legal, and they exist because the government built them for exactly the situation you might be in right now. The only step left is filing them. If this video gave you even one thing you didn't know before, do 2 things. First, talk to a tax professional or contact the CRA directly about which of these 5 apply to your situation. Every household is different, and this video is general information, not personalized tax advice. Second, if you found this useful, subscribe, because we cover benefits like this every week, the ones that quietly disappear if nobody tells you about them. Thanks for watching, and I'll see you in the next one.